Welcome to Investomania, brother!
You know what I like to do when I'm not picking great stocks to make you guys consistent money? I like playing video games, and I bet a lot of you guys do as well. Gaming is a secular growth story which has been intact since the 1980s, and today we go over everything from the consoles to the games to the retailers. First, let's take a look at the retailers. Retailers like Walmart, Best Buy, Amazon, and GameStop are responsible for the majority of games sold. However, video game sales are such a small percentage of sales for major retailers like Walmart, Best Buy, and Amazon, it doesn't really make a lot of sense to buy the entire company specifically for their video game-related sales. That's not to say we don't like those companies. Walmart's most recent quarter was a blowout, and Amazon is still strong. I like Best Buy too, but I'd rather be in Walmart or Amazon. Then we have the dedicated video game retailer, GameStop. Once upon a time, this stock was hot. But as more and more people began purchasing video games as direct digital downloads, as well as through online retailers like Amazon, GameStop got left in the dust. The new trend is purchasing online one way or another, and GameStop is on the wrong side of that trend. The stock has an 11.45% dividend yield, and I call that a red flag. I do not believe that dividend is safe long term. I recommend you stay away from GameStop. Now let's talk about the consoles themselves. We have three primary players in this market: Sony with the PlayStation, Microsoft with the Xbox, and Nintendo with the Nintendo. Sony is a Japanese company, but their stock can be purchased as an ADR or an American depository receipt, which means you can purchase it in America. Sony is okay, but it's not my first choice since Sony is a large company and I don't like so much their other moving parts. At least I don't want to put my money in that company. I think there are better places I could put their money. Now, if their entire company, if they spun it off, I'd be more than happy to purchase PlayStation as a standalone company, but I'm not a huge fan of Sony as an entire company. Microsoft is in a similar situation with the Xbox. I wouldn't recommend buying Microsoft exclusively for Xbox if you're only going to buy one video game related stock. However, I do like Microsoft overall, and the overall company is much stronger than Sony in my opinion. Therefore, I would bless a buy so long as you are happy with the other aspects of Microsoft and are not doing it exclusively for Xbox. Now we are left with the OG console, or at least OG relative to PlayStation and Xbox, and that's Nintendo. Nintendo, like Sony, is a Japanese company which can be purchased in America as an ADR. Nintendo is the only pure-play, publicly traded gaming console. Unfortunately, it's been losing market share for many years. While Nintendo may have been the clear market leader in the 1990s, nowadays they are a distant second to PlayStation, and depending upon how you run the numbers, sometimes are even behind Xbox. Let's take a bit deeper of a look into Nintendo's business structure. Ever since Nintendo originally released the original Game Boy in 1989, Nintendo's business structure has had a home-based console leg and then a mobile leg. Before smartphones, the handheld devices leg were doing fantastic. However, with the advent of smartphones and an ever-increasing number of both free and paid smartphone video games, the percentage of the company's sales coming from the handheld market has been shrinking. Nintendo has done a good job with their most recent console, the Switch, which is the first ever truly dual-purpose console produced by a major manufacturer. The Switch can operate as both a home console and a handheld device. The Switch has been selling well and is rejuvenating interest in Nintendo products. However, should you buy the stock? Despite its long-term shrinking market share, I'm pounding the table on Nintendo. It's still the preferred console for children. It has, at least now, a definable advantage over PlayStation and Xbox with its dual-purpose use, And the negativity over its declining handheld dedicated consoles has already been hammered into the stock in previous years. Year-over-year revenue growth is now up a staggering 116% on the heels of the release of the Switch. Strong sales are expected to continue with this popular console. However, you need to understand the life cycles of how these consoles work. Similar to a car that might have a life cycle of 7 years, typically you will receive a massive influx of revenue on that first year or two, and then the sales will kind of drift off a bit. That's to be expected. However, there is an anticipated area of growth for Nintendo in the works. Both Xbox and PlayStation have already created a subscription service where users pay a monthly fee for access to an online catalog of games. Both of these subscription services have done well and are expected to continue to grow. Nintendo has yet to release a subscription service. I personally believe eventually they will. It will also probably be cheaper than the Xbox and PlayStation equivalent, and I think it will be a hit. Now let's talk about the game developers. We've got Activision Blizzard, Electronic Arts, Take-Two Interactive, Tencent, GLUU Mobile, and Zynga, to mention a few. There are several other smaller ones, but these are the ones we're going to focus on. Let's start off with the console developers. Activision Blizzard, Electronic Arts, and Take-Two Interactive. Activision Blizzard has titles such as Call of Duty, World of Warcraft, StarCraft, Hearthstone, Destiny, Skylanders, and Diablo. They also own mobile game developer King Digital, which is primarily known for its title Candy Crush, but also contains titles such as Farm Heroes and Pet Rescue. Activision Blizzard has demonstrated its ability to constantly produce massively popular games and then sustain long-term revenue on those games. World of Warcraft being the best example, which has consistently generated strong revenues for 14 years going. Activision Blizzard has strong footing in console gaming, online gaming, and now mobile gaming with its acquisition of King Digital. Plus, it is the only gaming company on this list that pays a dividend. It's around 0.5%, so it's not that big, but hey, it's better than 1/2 of nothing. It's safe to say, wherever gaming goes in the future, Activision Blizzard will be there. Take-Two Interactive is another popular developer primarily for console gaming. Titles include Red Dead Redemption, the NBA 2K series, the WWE 2K series, Borderlands, Civilization, and Mafia. Lest we not forget the granddaddy of them all, the Grand Theft Auto series, which includes the massively successful GTA Online with over 160,000 active players. Take-Two has been focusing on growing the GTA Online community, trying to make it as sustainable as possible for long-term revenue, and has added many microtransactions into the mix for sustained long-term revenue, which thus far has been successful. The stock is not cheap at 85 times earnings, and it has a 3-year average growth rate of 18.3%. Then we have Electronic Arts, or EA, with popular titles such as the Sims series, the FIFA series, Star Wars Battlefront, Battlefield, Anthem, and Need for Speed. I like EA, and it doesn't hurt that it's also the cheapest, at least relative to Take-Two and Activision Blizzard, with its PE ratio of 51. EA launched a subscription service on the Xbox One back in 2014 called EA Access, and in 2016 EA created Origin Access, which is their subscription service for PC, both of which are something that Take-Two and Activision have not done. In March of 2018, EA stated they were looking to add other publishers' titles as well as indie games to Origin Access. EA already has a massive catalog of games which can support their subscription service to a degree. However, if they can successfully bring in other publishers and indie titles, then Origin Access will operate more like a platform. Here at Investomania, two things we love are subscription services and platforms. You put those two things together and you have the opportunity for long-term growth and market dominance. However, there is some downside to this strategy. EA Access, and that's the one on Xbox, now has massive competition coming from Xbox directly since the launch of their own subscription service, the Xbox Game Pass, in June of 2017, and will likely have even more fierce competition on the subscription front, as on August 27th, 2018, the release of Xbox All Access, which allows people to bundle their Xbox console along with Xbox Game Pass and Xbox Live Gold, was introduced. With this new subscription service, people can avoid the expensive one-time purchase of the Xbox console and instead make smaller, more affordable monthly payments. Think of it like how phone carriers often bundle a phone with the cell phone service and allow people to make smaller monthly payments to avoid the large upfront cost of a smartphone. I think I was going to say smell phone. Xbox All Access is currently in a testing phase, being released only for a limited time, but I bet if it goes away, it'll come back, and I think sooner or later it will be here to stay. It makes sense. As a side note, down the line, I think the bundling of consoles into monthly payments will be common among, also with Nintendo and PlayStation, and I believe this will allow Microsoft, Sony, and Nintendo to make much better margins on their consoles. Currently, the companies follow the razor blade business model, where you sell the razor, or in this case, the console, at thin margins, or sometimes even at a loss, and then sell the razor blades, or in this case, the video games, at high profit margins. Because Sony and Microsoft currently sell their console as a standalone upfront purchase, this limits how much they can charge. Once they start rolling this into a monthly payment, I think future consoles will see their prices significantly raised. I mean, it's bad for the consumer, but it's good if you're an investor. Think about it like the iPhone. How many units do you think the iPhone would really be selling if people had to pay $1,000 up front for it? Most people don't even have $1,000 in their bank account. Roughly 80% of Americans live paycheck to paycheck. They can't afford to pay $1,000 upfront for a phone. But how many people are willing to put down between, $0 and $300 and then pay $20, $25, $30 a month for 2, maybe 3 years? Almost everyone. That's why 94% of Americans aged 18 to 29 have a smartphone, despite most of them not even having $1,000. I think this business structure will help Sony, Microsoft, and Nintendo, although again, I would prefer Microsoft at least over Sony, as I like the rest of their business and I think it's stronger. But of course, I also like Nintendo, as that's the pure play. So, should you consider EA now that it has intense competition from Microsoft directly? Well, it's all about price. The price of EA stock has come down significantly over the past couple months. I mean, we're down about 24% in recent months due to lowered guidance, as well as the delay of Battlefield 5, which I don't necessarily think is a bad thing, because I think it's going to be up against less competition now that it's delayed. I think this was an overreaction from the market, and EA now possesses a nice risk-reward now that the stock is down about 24%. If EA can continue to grow its subscription service, whether that be on the Xbox or on the PC, hopefully both, that'll help drive the stock up. And if they can't grow the subscription service, they're just going to be in the same situation that Take-Two and Activision are. Right? They still have a large portfolio of extremely valuable IP, which they can continue selling as standalone purchases and or add more of their content to the likes of Game Pass and PlayStation Now. How about Tencent, which is a Chinese company who receives about 40% of their revenue from gaming? While I like Tencent quite a bit, I am not currently recommending any Chinese stocks. I had a few, I got rid of all of them. The Chinese stock market is currently experiencing significant issues due to the Chinese government creating an unfriendly environment for businesses to thrive. Until the Chinese government turns things around, I don't want to own anything in China. That's not to say there won't still be some winners, and I'm willing to miss out on those. I don't need to take the risk or the headache when there are a plethora of great stocks elsewhere to choose from. What about mobile gaming? Stocks like GLUU Mobile and Zynga are two of the larger in this area, at least that are public standalone companies, right? Of course, you have like the King Digital and stuff, but those are those aren't standalone public companies. So if you're just looking for a standalone public mobile gaming play, GLUU Mobile and Zynga are two of the larger ones. GLUU Mobile has games like Kim Kardashian Hollywood, which really put their stock on fire a couple years ago. The Swift Life, which is kind of a similar concept, but with Taylor Swift, Deer Hunter, and Tap Sports Baseball. Zynga's list is impressive with Farmville, which, my girlfriend has spent like $1,000 on that game against my desires. But I know from personal experience that Farmville and those microtransactions work, and our collective net worth is $1,000 lower about this past year due to it. They also have the likes of Chefville, Zynga Poker, Words with Friends, CSR2 Racing, and the Wizard of Oz slots. While long-term, I expect both of these companies to grow, they are far from my top picks. Why? A lot of volatility. With a new hit, these companies are still small enough that with a new hit game, you can double your money in less than a year. However, without a new hit game, particularly if you get in towards the higher end and then the popularity of the existing games are going down, you can easily lose over 50% of your money in a couple months. Timing is important when you get into stocks like these. You really need to pay attention to your timing. You do not want to be buying into this when they just released a real new popular game and it's already pushed the stock up significantly. You want to be buying stocks like these when everybody hates the stock and there's no new popular games, or at least it just came out and the stock hasn't already moved dramatically with the release of that new game. You want to do it when your downside is minimized. In contrast, right now, GLUU Mobile is currently up 137% in about the past 6 months due to stronger than expected recent numbers. Expectations are currently high, and therefore so is the risk. If you feel you can predict which new games are going to be a hit, and you feel comfortable stomaching a 50% plus loss, then you may want to try a small position in one of these stocks as a speculative play. But if you don't feel comfortable and you don't think you can predict the successful games and you can't stomach significant losses, you do want to stay away from these mobile gaming type stocks. If you want some exposure, of course, you can do like the Activision Blizzard, which has some indirect exposure through its acquisition of King Digital. I love the growing gaming space. This secular trend still has many, many years of growth ahead, of significant growth. If you think, or you kind of consider yourself the stock picker, as I like to feel like I'm a stock picker, then hey, you go ahead and you pick your one or two favorite stocks. If, on the other hand, you're not super confident in picking one or two stocks and you would just like the broad exposure to the gaming space, but you don't want to take a high amount of risk, I'd recommend creating your very own gaming index, which I'll get to in a moment. Here are my personal recommendations for individual gaming related stocks from least favorite to favorite. GameStop, just no. Best Buy. Buy it if you want. I still think it's a buy stock, but it's definitely not something I'd I think there are better options out there. Zynga, I'll bless it as a speculative play. Tencent, not until the Chinese business environment improves. GLUU Mobile, I prefer over Zynga, but they're both speculative plays. Sony, PlayStation is great, but I'm not a huge fan of the other 75% of the company. Walmart, a safe bet for steady growth. Amazon, my favorite of the stated retailers. Nintendo, best pure play on consoles. Microsoft, I like the Xbox, which is only about 10% of their revenue, but I also like the rest of the company of Microsoft. Electronic Arts, currently seeing a nice entry point from an affordability standpoint of that stock. Activision Blizzard, strong and diversified catalog of content. Take-Two Interactive has better growth potential over the next couple years, in my opinion, compared to EA or Activision, which are both already much larger companies. If you would like to create your own gaming index, I would recommend the following. Take-Two Interactive, 17.5%. Activision Blizzard, 17.5%. Electronic Arts, 17.5%. Microsoft, 12.5%. Sony, 12.5%. Nintendo, 12.5%. GLUU Mobile, 5%. Zynga, 5%. There you have it, my recommendations for how to play the booming gaming market. Let me know what you guys think. Do you agree or disagree? Is there a stock you think I missed? Let me know in the comments section, and until next time.
Subscribe to Investomania, brother.